Good morning. This is Bloomberg Daybreak Europe. I'm Lizzie Burden in London, and these are the stories that set your agenda. Give and take. Shares gain in Asia as the US president floats a tariffs exemption for autos and car parts, but warns he's pushing ahead with new levies on pharmaceuticals and semiconductors. Bessent's balm for the bond market. The Treasury Secretary tells us there's no evidence of foreign governments selling US debt. He says his department is ready for any signs of market instability.
We have a big toolkit that we can roll out. We do regular off-the-run buybacks. We could up the buybacks if we wanted.
Plus, LVMH sales slump on weak consumer demand in China and the US. The world's biggest luxury group warns it's considering price hikes to offset the impact of tariffs. Flexibility wrapped in uncertainty. That seems to be the state of play when it comes to tariffs, and it's reflected in these markets this morning. The optimism continues, the upbeat start to the week for the Asian session, up 1.2% on the MSCI Asia Pacific Index, but we're down on European futures this morning and down as well the other side of the Atlantic. As I say, we've had mixed news when it comes to tariffs over the past 24 hours. Good news, perhaps, for autos, less good news when it comes to drugs and chips, and we'll get more on that in just a moment. But if we flip over the board to the cross-asset picture, of course, the big question on our minds has been, are Treasuries and the dollar not so much of a safe haven anymore? But you are seeing a bit of a recovery on the 10-year yield this morning. 4.34% is where we're at right now. We're keeping an eye on cable because we've got the UK jobs numbers coming out at 7 a.m. London time. 132 is where we trade at the moment, so stronger on the pound, weaker on the dollar again. Brent trading at $65 a barrel, 0.3% up this morning. We've got to factor in these tariff talks, of course, but also we've had the announcement of the demand coming down when it comes to a couple of trim demand forecasts, and Iran signalling higher potential output as well. But just look at gold here. I'll leave you with gold. We're up 0.6% on the yellow metal, and that really just underscores that traders are clinging for certainty, aren't they? They need caution amid all of this tariff unrest. Let's get over to Avril Hong now in Singapore. She's got a check on Asian markets. Avril, over to you.
Yeah, Lizzie, we're seeing Asian markets extending gains from a day ago, helped along by that stability that sort of returned to Wall Street, particularly for US Treasuries. It's also tariff headline driven. I mean, the suggestion that maybe we see reprieve for autos, that's helping those transport-related stocks in this part of the world. Look at the gauge of them on the Japan topics, the top performing sector today. Chips also doing fairly well, all things considered, but you are also getting the sense of lingering recession, global growth concerns. And just to give you a sense of that, flip the board and take a look as well at how things are kind of moving sideways in the FX space. When you look at the renminbi, the Japanese yen, even the Bloomberg dollar index at the moment, this might be the state of play until we get clarity on the tariff situation. We are also getting the sense that for the Japanese yen, its safe haven qualities might ultimately override any expectations being dashed about the BOJ maybe not hiking at its next meeting. For dollar renminbi, we also got a slightly lower fix from the PBOC today, but that's not to say that the medium-term path for dollar yuan is not going to be higher given how it's brought into this tariff equation. Now, we're also going to be keeping a close watch on the China GDP numbers due tomorrow, and they're expected to show solid growth for the first quarter. Consensus is for it to come in at 5.2%. Of course, this is something that captures the period before the Trump tariffs, but it would give us a sense of how China's economy is coping amid all this. The key thing to watch would be the pickup potentially in retail sales and whether government handouts, subsidies have helped trickle through into the Chinese economy. But from here on out, though, a lot of economists are already flagging that they expect deterioration in Chinese growth simply because there doesn't look to be an off-ramp when it comes to tariffs from the US. Lizzie?
OK, Avril Hong, we thank you for that update on Asian markets. Let's get to some breaking news now. We have results out of Ericsson, first quarter earnings just crossing the terminal, and it is a beat when it comes to EBIT. So first quarter EBIT coming in at 6.21 billion Swedish kronor. The estimate was for 5.09 billion Swedish kronor. Of course, as with all earnings this season, the exposure to tariffs is a focus. And we have Ericsson saying that they continue to focus on controlling what we can control. So really echoing what many CEOs have been saying this season. But they say that their networks outlook does include a 1 percentage point negative tariff impact. So we'll see how that translates into the share price at the open. Shares down 19.5% so far year to date, 18.1%, I should say, as you can see there on the screen. Let's get over now to Bill Ferries with a look at how the tariffs are playing out on the policy front. President Trump, of course, saying that he's exploring possible temporary exemptions to his tariffs on imported vehicles and parts to give auto companies more time to set up US manufacturing. But the president also floating imposing more tariffs, new tariffs on pharmaceutical imports.
We're going to be doing that. That's going to be like we have on cars. We have, as you know, a 25% tariff on cars. We have a 25% tariff on steel and aluminum. And that's what that category fits right now.
Do you have a percentage in mind and a timeline?
I have a timeline, yeah, not too distant future.
Bloomberg senior editor Bill Ferries joins me now. So, Bill, I'm going to start with the good news. We've got no particular specifics when it comes to these auto tariffs and the reprieve here, but does it show at least that Trump's willing to negotiate, as Scott Bessent told us?
Well, President Trump himself said that he doesn't change his mind, but that he is flexible. So I suppose this is part of that flexibility. It could also just be an acknowledgement of the pressure of reality coming in, where people were looking at much higher prices for automobiles and for some of these other goods. We saw him step back from those broad global tariffs, reciprocal tariffs, as he calls them, last week. And now there's more talk about these sectoral tariffs, perhaps some relief for the auto sector. I think President Trump wants to see more of that manufacturing shift to the U.S., but there's been a lot of pressure or acknowledgement that that is going to take time. You don't just build these factories, whether for autos or for the auto parts, right away. He seems to be willing to give that a little bit more time, but we still need to see if there is a reprieve for the auto sector. Right now, it's just speculation at this point.
OK, so potentially more capitulation as reality bites. But if we move to the bad news, Bill, Donald Trump initiating probes on chips and pharma as potentially a precursor to more tariffs. Do we know what the scope is here?
Well, President Trump has ordered the Commerce Department to do what they call a Section 232 probe into both semiconductor imports as well as pharmaceutical imports. That gives the Commerce Department 270 days, 9 months, to complete a look at that. Given what we've seen from the administration so far, I would expect it to be done much more quickly. But the normal end result of that process would be new tariffs on that sector. That's going to hit a lot of American companies as well as foreign companies, of course. Eli Lilly, Pfizer, they have big operations in Ireland for exporting to the U.S. And there's going to be a real question as that deadline approaches about whether President Trump was willing to make American medicines, pharmaceuticals really cost more at the pharmacy. But that's the latest blow in what is, as you know, a daily shift in what the administration's tariff policies are.
OK, Bloomberg senior editor Bill Ferries, we thank you. And we'll get more later in the programme on how other countries around the world are reacting to that latest tariff news. But let's turn to how the markets are dealing with it. The US Treasury Secretary is really playing down the recent bond sell-off. He's dismissed speculation that foreign nations are dumping their US Treasury holdings. In an exclusive interview, Scott Bessent told us his department has the tools to address dislocation if needed.
Treasury has lots of things we can do, and but again, I think we're a long way from that. But again, we have a big toolkit that we can roll out. We do regular off-the-run buybacks. We could up the buybacks if we wanted.
Well, Bloomberg's Valerie Teitel joins me now for analysis. And Val, we're seeing a bit of relief when it comes to 10-year Treasury yields this morning, down 3 basis points. And you heard there, Bessent playing down the bond market sell-off last week. Interesting that he doesn't think there's been a sell-off, a bit of dumping of Treasuries by the likes of China, isn't it?
Yeah, he reiterated that we actually saw decent foreign demand at the 2 big Treasury auctions last week. But all of this downplaying of the bond rout is really pushing some calm within the Treasury market, Lizzie. The first rally that we've seen in 5 sessions took place yesterday. And now, since the beginning of the week, the 10-year yield is down nearly 15 basis points as some calm returns to the market. Bessent also talked about the toolkit that the Treasury does have. He mentioned they'd be willing to up buybacks of off-the-run Treasuries. These kind of things just aid liquidity to the Treasury market. We've actually seen liquidity very much return. If you look at how swap spreads have reacted so far this week, after blowing out to historic wides, we've seen swap spreads narrow, which is a good indication that liquidity is returning to the Treasury market.
And meanwhile, we've had lots of Fed speak in the past 24 hours. I feel like the tone is a need for patience, caution on Trump's tariffs. Tell us more.
Yeah, we heard that from Fed's Bostic. He's saying now's not the time for any big policy moves, and he's urging patience. We had some dovish comments from Fed Governor Christopher Waller. He emphasized that, again, recession risks take front and center in his mind versus inflation risk. He used a different T word when it came to talking about tariff-induced inflation. He's calling it temporary, saying my best judgment is that the higher inflation from tariffs will be temporary. And he is instead focused on the downside risks to growth over these inflation risks. Now, we have seen a bit of evidence that maybe this inflation shock will be temporary. We've seen it in the New York Fed survey of consumers of their inflation expectations. While we have seen a jump in 1-year expectations, the 3-year and the 5-year, that's the longer run inflation expectations have remained well anchored. This is something that Powell brought our attention to a few weeks ago, and also something that Fed Governor Waller brought attention to as well yesterday.
Temporary, transitory, it's all pretty bold if you ask me. Bloomberg's Valerie Teitel, we thank you with that latest Fed speak. Now, coming up today, we've got a few things on the docket for you. At 7 a.m. London time, top of the hour, we've got the latest UK jobs numbers. Not expected to show much progress on wage disinflation. Unemployment expected to drop only slightly to 4.3%. But I would note, these numbers really have been the bane of policymakers' lives in the UK because of the poor quality data, because of the low response rate to the labour force survey. So we approach these with a wheelbarrow of salt, shall we say. But then at 10 a.m. London time, we're going to get the German ZEW survey, one of the first major surveys out of the euro area for April. So it should give us a bit more of a flavour of what to expect from the rest. And of course, tariff policies are not likely to make this pretty reading. And then later in the day, we've got more US bank earnings out of Citigroup and Bank of America it is today. Estimates suggesting that Citi's equity trading grew even as its banking segment shrank for the first time in nearly 2 years. Bank of America projecting a 10% gain in equity trading. That's the weakest of the pack, according to analysts. But we'll dive into the detail for you later in the show with our reporter, Charlie Wells. Coming up next, though, after the EU Trade Commissioner met the US Commerce Secretary, what are the prospects for an actual deal? We'll talk about that next. This is Bloomberg. Welcome back to Bloomberg Daybreak Europe. Now let's look at how the global response is shaping up to Donald Trump's tariff policy. The EU Trade Commissioner Maroš Sefcovic says that the EU is ready for a fair deal with the US after he met with the Commerce Secretary Howard Lutnick. This after Spain's possible pivot towards China caused concern in Washington. Let's bring in Bloomberg's Oliver Crook now for analysis. Ollie, the big question, can the US and the EU make a deal?
Yeah, so Lizzie, I think everybody wants a fair deal. I think everybody's got a pretty different idea of what that means. Let's just get to the tweet that we got from Maroš Sefcovic, the trade representative from the EU, after his discussions with leaders and policymakers over in the United States, saying that the EU remains constructive and ready for a fair deal, including reciprocity through zero tariffs. On industrial goods and also working on non-tariff barriers. Let's deal with each of those, right? There's zero for zero. This is the proposition of basically creating a free trade zone between the EU and the United States on industrial goods. We should say that before all of the tariff activity that the United States imposed upon the EU and around the world, the basic difference in terms of tariffs between the EU and the United States was about 0.5% on average. So if we're going to imagine what the United States wants, they're going to want something much bigger than that. That takes us to the very thorny and very complex discussion of the non-tariff barriers that the U.S. wants to dissolve from the EU. What they mean by that is still not entirely clear. We had Peter Navarro over the weekend talking about value-added tax. Whenever you talk to ministers in Europe about getting rid of the value-added tax, it's basically a non-starter. It's effectively a sales tax that is indiscriminate on whether something is an export or an import. You have food safety standards. This is another issue that the Trump administration has brought up on repeated occasions. There are also potentially something where you could actually find some space, potentially auto regulations. If you have a sort of uniform auto regulation for the EU and the United States, you don't need to have two different kinds of cars for two different kinds of regimes. So these are some of the conversations that are being held here. The fine line for European policymakers is basically giving concessions to the United States while at the same time not really letting D.C. legislate domestic law to the Europeans.
And so, Ollie, given the reprieve that we might see when it comes to autos, given that we're seeing the DAX outperforming in terms of the futures this morning for Europe, the DAX is up 0.25%, Euro Stoxx 50 futures down 0.1%. What do you expect is going to be the reaction from Europe's automakers this morning?
Yeah, so let's just get to sort of what the president actually said, because in all of these discussions and basically the markets hanging on every single word of every single member of the cabinet, we did hear from Donald Trump yesterday talking about the auto tariffs. Have a listen to what he had to say.
I'm looking at something to help some of the car companies where they're switching to parts that were made in Canada, Mexico, and other places, and they need a little bit of time because they're going to make them here. But they need a little bit of time. So I'm talking about things like that. But the European Union has taken terrible advantage. They don't take our food products. They don't take our cars. We have millions of their cars, BMW, Volkswagen, Mercedes-Benz, many others. They come in by the millions. They don't take. There are no Chevrolets in Munich, I can tell you that.
And Lizzie, I can confirm I've never seen a Chevrolet in Munich, but what we might be able to see is no tariffs imposed on those low-cost parts. And this is a huge part of the system here for these automakers who have been lobbying the Trump administration for a number of months to try to get a sort of carve-out. Remember, he already delayed the tariff on those low-cost parts until May the 3rd. We may get that extended a little bit further, and we saw a very sort of euphoric reaction in the U.S. automakers. We saw Ford, GM, Stellantis all gaining a lot yesterday, just showing you, Lizzie, how sensitive this market is to any potential bad news, but of course, also to good news.
OK, Bloomberg's Oliver Crook, we thank you. And we may get more news out today. We've got the Treasury Secretary Scott Bessent set to meet the Spanish Economy Minister later on. That'll be awkward, won't it, given that Bessent was only just last week blasting Spain for its potential pivot towards China. But coming up, Donald Trump casts doubts over US nuclear talks with Iran, despite negotiators having sounded pretty upbeat after last Saturday's meeting. We'll bring you all the details next. This is Bloomberg. Welcome back to Bloomberg Daybreak Europe. It's 6:23 a.m. here in London, and we can turn our attention now to geopolitics. Bloomberg understands that the US and Iran are expected to hold their second round of nuclear talks in Saturday in Rome. It follows their first meeting in years in Oman over the weekend, which both sides had called constructive. But President Trump has now expressed skepticism about Iran's willingness to negotiate. Bloomberg's Paul Wallace joins me now from Dubai with more. Paul, you know Iran well. How are they going to react to Donald Trump saying they don't know how to deal with us and that he's considering striking Iranian nuclear facilities still, even though these talks are happening?
Hi, Lizzie. I think this just goes to show how complicated these talks will be. And Donald Trump has spoken about getting a deal within 2 months. And a lot of people who have watched Iran and its nuclear program over the years have said that's just impossible. There's just too much to agree to here. It's unclear what exactly Trump is talking about, why he's suddenly turned around after giving pretty optimistic comments on Saturday evening. Both Iran and the US said the talks in Oman were constructive, and they obviously agreed to follow up these follow-up negotiations this coming Saturday. It's unclear what's sort of change with if Trump's thinking, whether there was anything specific or he was just talking in general terms. As far as how Iran will take it, I think they realize that Trump is prone to say things that are going to frustrate them. He's not a normal president, shall we say. He's a pretty different leader by US historical standards. So I don't think in and of itself that's anything to derail these talks. Unless there is something specific going on in the background that hasn't been made public. But as far as we're aware, the second round of the talks on Saturday still stand.
But what do the talks next weekend look like they're going to produce at this point? There appears to be some confusion as well about where they're even going to be held.
Exactly. From what we reported, and Italy has in fact said on the record that it would host them on Saturday, and our understanding is that both Iran and the US asked Italy to do that. Iran put out a statement sort of implying that maybe they would be in Muscat again in Oman, so it's a bit confusing as to where exactly negotiators will meet. But I think the bigger question is just what you've asked. What will they be talking about? What are the specifics? How are they going to move forward from last Saturday's talks, which were pretty much a meet and greet? Can the US and Iran, sit down in a, not necessarily in the same room, but in the same country, in the same city, with a mediator like Oman, and actually make some progress? And they seem to last Saturday. But how do they move on to the trickier questions of curbing Iran's nuclear program, potentially easing sanctions on the Islamic Republic? All these things are much more difficult, and we're just going to have to see after Saturday's talks, what exactly they've decided and what the next steps are.
OK, we'll get into the nitty-gritty next weekend. Paul Wallace, Bloomberg's Middle East and North Africa economy and government editor, we thank you for the latest. Now, the US Special Envoy Steve Witkoff has described talks with the Russian President Vladimir Putin last week as, quote, compelling. Speaking to Fox News, Witkoff said that Putin has made a request to secure a permanent peace with Ukraine, but he says that Russia insisted that seized parts of Ukraine since 2014, including Crimea and the Donbass region, must be recognised in any accord. So some of your latest geopolitical news there as we look at futures pointing lower on both sides of the Atlantic this morning, but a bit of brightness on the DAX futures as well as the FTSE 100. We'll get more into the markets next. Wall Street banks as well continuing to report earnings. We'll have that next. This is Bloomberg. A very good morning. This is Bloomberg Daybreak Europe. I'm Lizzie Burden in London, and these are the stories that set your agenda. Give and take. Shares gain in Asia as the US president floats a tariffs exemption for autos and car parts, but warns that he's pushing ahead with new levies on pharmaceuticals and semiconductors. Bessent's balm for the bond market. The Treasury Secretary tells us there's no evidence of foreign governments selling US debt. He says his department is ready for any signs of market instability.
We have a big toolkit that we can roll out. We do regular off-the-run buybacks. We could up the buybacks if we wanted.
Plus, price rises for pricey products. As LVMH sales slump on weak demand, the world's biggest luxury group warns it's considering price hikes to offset the impact of tariffs. Well, a very good morning. Welcome if you're just joining us, and we can check in on these markets, look at the futures, and they are pointing lower on both sides of the Atlantic this morning. Down on S&P E-minis by 0.2%, down on Euro Stoxx 50 futures by about 0.25%, but a bit of brightness when it comes to FTSE 100 futures and DAX futures as well, echoing some of the optimism that we've seen in the Asia session, perhaps on this latest tariff news. So we are set to have potentially a reprieve when it comes to autos, but more misery when it comes to drugs and chips. So we keep an eye on that. We watch the likes of ASML and Novartis at the start of the European cash trade for how they respond. But if we flip over to the cross-asset picture, the question does remain, to what extent has Donald Trump inflicted lasting damage on both the dollar and Treasuries as the ultimate safe havens? This morning, you're looking at Treasury yields actually giving a bit of relief. So they're down 3 basis points at 4.34%. The dollar weakening, though, continuing to weaken. And we keep an eye on cable ahead of that jobs data out of the UK at 7 a.m. London time. $1.32 is where we trade on sterling. $65 a barrel on Brent, up 0.3%, having slipped yesterday on trim demand forecasts, a couple of them, and Iran as well, signalling higher potential output. And we have gold there, climbing again, up 0.4%. And doesn't this just underscore that traders still are reaching for comfort as the tariff flip-flopping continues? Of course, the tariff news dominates the agenda, but we also have to factor in the earnings season that is ramping up, with a focus now on US banks. Bank of America and Citigroup are on tap to report their results today after Goldman Sachs stock traders posted their highest quarterly revenue haul on record yesterday. On the bank's earnings call, Goldman CEO David Solomon expressed a degree of optimism when it comes to trade policy.
This uncertainty around the path forward and fears over the potentially escalating effects of a trade war have created material risks to the U.S. and global economy. We are encouraged by the administration's recent actions to pursue a more gradual policy process that allows for considered negotiations with many countries. But how policies will evolve is still unknown.
Bloomberg's Charlie Wells is here to bring us up to speed on all the latest. Charlie, Goldman, you heard Solomon there. What was his outlook for the US economy? And, tell us what he said about regulation, because it sounds like he's been a bit hopeful.
It does sound like that, Lizzie, and you could really hear him try to put a kind of positive spin on what's been a very uncertain time, right? So you heard him there talking about how he liked this kind of gradual shift on tariff policy without even mentioning the word tariff, I should mind.
Clever.
And also really trying to kind of bring the narrative back to what we were hearing about kind of post the Trump election in November. So, maybe try to forget the trade war, maybe try to forget the uncertainty. Let's talk about deregulation. Let's talk about rollback on a number of issues, from leverage to capital to just kind of overall banking regulation. So that's what he was really trying to push there. But let's not forget that, Goldman's earnings were a little bit mixed there. Of course, across the board, they had a significant beat, but there was some real weakness in areas of investment banking in particular. So this was an attempt to kind of shift focus away from that towards the future, towards a more positive story.
Yeah, it's interesting that you've got, this three-legged stool when it comes to Donald Trump's economic policy, Trumponomics. Of course, you've got deregulation, tax cuts and tariffs. Maybe Solomon trying to nudge the president towards the things that are going to help him. Tell us about what we're expecting from Citi and Bank of America when they report later today.
So these two banks are going to round out the Wall Street bank earnings season. And I think, again, the focus is going to be on how these huge institutions are navigating the trade war. And I think when we think about Citigroup, this is going to be a really interesting one because, of course, Jane Fraser is in the middle of a big transformation of that bank. But also, Citigroup facilitates a lot of global trade. And so if you want to kind of understand how some of these banks might differ across the board, you might want to think about kind of where a lot of their net revenue comes from. At Citi, a lot of that, significantly more than the other banks, comes from abroad. So that's one issue. They also have a significant proportion of their loans coming from credit cards. So that could be a potential weakness if the economy does slow down, as some people think might happen in a trade war. Thinking about an economy slowing down, I think in focus for Bank of America is going to be net interest income. So what does it look like if we get to a world where loan demand slows down? What does it look like if that rate picture is less favorable for their lending businesses? So those are the kind of keys for these two final big banks.
Okay, so you'll be across that for us over the next 24 hours. But just while we've got you, Charlie, I wanted to ask you about this Bloomberg scoop that some of the Wall Street giants are limiting how much information they want to share with the OCC, the Office of the Comptroller of the Currency, because they're worried about getting hacked.
That's exactly right, Lizzie. So Bank of New York Mellon and JP Morgan, Bloomberg News has learned, have paused sharing information with the Office of the Comptroller of the Currency, at least electronically. And this follows a hack that Bloomberg reported on earlier this month of over 100 employee accounts at the regulator. It's still unclear who is responsible for the hack, but what we do know is that sensitive financial information was available to be spied on. And so these banks are concerned that their own computer networks could be vulnerable. And this gets at this really difficult tension right now where financial institutions are worried about their own data. But of course, the OCC regulates all of the U.S. national banks. And so there's this issue of, are they sharing the information that regulators need? This is something we're certainly going to be hearing more about. It's unclear how all the other major U.S. banks are handling news of this hack. But this is a tension that we're going to see now in regards to this hack. And of course, more as financial institutions, are subject to these and have been over the past few years.
And you could take that further. The growing questions, skepticism around U.S. institutions, DOGE, around Treasuries, in the context of this administration. Charlie Wells, we thank you for that reporting. Now, to more earnings. Here in Europe, we had LVMH sales falling more than expected in the first quarter, weighed down by weak demand for luxury goods in China and the US, and of course, the threat of the trade war. LVMH shares on Tradegate are falling this morning. They're down about 5.3% against the Paris close. So we can get more detail now from Bloomberg's Angelina Rascouet. Angelina, good to have you with me. I know you were watching these numbers as they broke. Just tell us what it indicates for the rest of what's to come from the European luxury earnings this season. Of course, LVMH, a massive player in this space, a bit of a barometer when it comes to luxury.
Yes, indeed, Lizzie. Overall, the results were negative, and crucially, the key fashion and leather goods units was down 5%. That was much worse than expected. And in terms of geographies, China is the region where it's hurting the most. But there was a lot of focus on tariffs and the impact on business. And what the CFO said is that the aspirational categories, so if you think about beauty and if you think about cognac demand in the U.S., these were the categories that were seeing maybe an initial impact, but so far the fashion and leather goods units, is proving solid when it comes to reacting to those tariff announcements.
All my favourite things going up in price, mon Dieu. Angelina, why can't they just expand US production, get round these tariffs?
Yes, and so when it comes to tariffs, there was a lot of questions about a price, as you say. She said that she believes that they have pricing power. Obviously, they can hike prices, and consumers may not necessarily curb their spending on those goods. So, but you have to take into account that in recent years, luxury brands have also increased a lot of their prices. So they're going to be, it's going to be a delicate move there. And when it comes to production, LVMH does have output production plants for Louis Vuitton and for Tiffany. Tiffany is a U.S. jewelry brand that they bought a few years ago. So she said that they have room to boost the output capacity in those two brands, but LVMH is not thinking of radically changing its U.S. output strategy.
Okay, Bloomberg's Angelina Rascoué, we thank you for that update. As we await more earnings this week, the likes of Moncler and Hermes, let's see if they fare better. We've already seen in the Asia session Prada shares down 4.29% in Hong Kong, so reflecting a bit of that pessimism off the back of those LVMH earnings. But let me now take you to one of our top interviews. The US Treasury Secretary Scott Bessent is hitting back after China's finance ministry called President Trump's 145% tariffs on the country a joke. In an exclusive interview, Bessent told us that there could be a decoupling between the world's two largest economies. And he also says that he's committed to getting trade deals done with several of the countries over the next 90 days.
I think now that we have the China tariffs in place, that they are going to want to have some protection from Chinese goods flooding their markets. That China's business model is like from that Disney movie where the brooms are carrying the buckets. Like they're not going to stop manufacturing because the U.S. has a tariff wall up, so those goods are going to go somewhere.
Where do you think they're going to dump?
Well, I think it depends on the good.
Well, we have exemptions now, though, for electronics, so we still expect electronics to come into the United States with the smaller tariff rate, the fentanyl, 20%.
But you were asking where are they going to dump. I think it will depend on what is the good. Higher value-added manufacturing goods, likely in Europe, Canada, in the G7, and then kind of more of the baubles and knickknacks in the global South.
China's Commerce Ministry came out when the tariff rates were going above 100% and called it, quote, a joke. Has there been negotiations on any level between Beijing and Washington right now?
Well, look, it'll come from the top. President Trump, Chairman Xi have a very good relationship. And I wouldn't say that these are not a joke. I mean, these are big numbers. I think no one thinks they're sustainable, wants them to remain here, but it's far from a joke.
Well, they just say that the rate is so high, it's become a joke. Basically, does it just stop trade between Washington and Beijing altogether? Do you see a decoupling of these two economies?
Well, maybe the trade minister has a different sense of humor I do, but I don't see anything funny about it.
Do you see a decoupling, though, between Washington and Beijing?
There doesn't have to be. There could be. There's a big deal to be done at some point, but look, what is different with China that is different in the history of trade, that normally, if you go back to the big trade deals or the currency deals in the 80s, the Plaza Accord, the Louvre Accord, the Reagan auto deals, our leading economic competitors were our military allies. China is both our biggest economic competitor and our biggest military rival. So that's going to require a special kind of formula.
Are you teasing out a Mar-a-Lago Accord that we should be paying attention for in the future?
I'm not sure what you're talking about.
Well, potentially getting all these trading partners together to discuss fair, balanced trade?
Well, we're doing that over the next 90 days.
US Treasury Secretary Scott Bessent speaking there exclusively with Bloomberg's Anne-Marie Hordern in Buenos Aires. That's his take on how these tariffs are going to impact the economy. Here's another. The Fed's Christopher Waller expects the US tariff impact on inflation to only be temporary. We'll discuss all of that next with Melanie Baker from Royal London Asset Management. Stay with us. This is Bloomberg. Welcome back to the Bloomberg Daybreak Europe. Let's turn to the economic repercussions of this tariff policy now, shall we? The Federal Reserve Governor Christopher Waller says that inflation's the inflationary impact of President Trump's trade policy is only going to be likely temporary. His view marks a departure from that of several other policymakers who've said that tariffs could have a more persistent impact on inflation. Joining me now to discuss is Melanie Baker, senior economist over at Royal London Asset Management. Melanie, good to have you with me around the table. We also heard from Wallace saying that the risk of a recession is bigger than the risk of escalating inflation. I wonder if you agree with that, because, I mean, it takes some confidence in the Fed's hold on inflation expectations, doesn't it, to think that if there is stagflation, they're not going to be in a straitjacket.
It does, yeah. And there are obviously risks of both. The inflation proves persistent and you go to recession. In terms of relative risk, it is a little bit difficult to sort of pull them apart. And the risk of recession in the US, I think, has dropped somewhat after the announcements over the weekends, the various reprieves. Still plenty of uncertainty around all those, of course. So I'd probably argue that the risk of recession has maybe drifted a little lower. On the inflation side, I mean, as we get the tariffs coming in, I am expecting a substantial impact on inflation. But I think he's talking about the outlook beyond just the near term. So when you're thinking about the impact a year ahead or beyond, what does inflation look like then? And I think it's reasonable at the moment to have a central case where that inflation impact does prove temporary, transitory, whatever word you want to use, but to not hold that view with massive amounts of confidence until you've seen real evidence that you haven't got second-round effects. It's not feeding through into wages.
That's encouraging. I mean, are you writing off rate hikes from the Fed?
I'm not absolutely not writing them off. I'm not going to write off anything for the Fed at the moment, given the uncertainty around policy. But absolutely, it's not my central case. I'm still seeing and expecting rate cuts rather than rate hikes from the Fed this year as the economy slows. But I'm not expecting recession at the moment. I'm very worried about the risk. And I said the risk has been bouncing up and down over the last week. But neither am I expecting it as a central case for inflation, that inflation impact to prove hugely persistent.
And what about the ECB? Because, of course, they're meeting in Frankfurt on Thursday. This meeting was meant to be the hairy one, where it really got interesting.
We're going to pause.
Yeah, but now that we've had the tariff news over the weekend, a bit of a reprieve for Europe, do we think that a quarter-point cut is nailed on?
I've never seen nailed on, but I mean, expectations appear to be pretty much unanimous that they will cut rates. If you look at consensus, I mean, it's hard to fight against that. You wouldn't want to necessarily as a central bank. But yeah, absolutely, you're right. In terms of developments, in terms of the tariff side, so the risks to euro area growth have worsened from that aspect. And then on inflation, I think they've had some encouraging messages on inflation. I think the last batch of inflation data would have been relatively encouraging. We had that further fall in services inflation, which would have been absolutely reassuring. And their wage data, I think, has been reassuring as well. So on all those grounds, I think it looks likely we're going to get a cut.
I mean, you joke about Christine Lagarde pushing back against market expectations. Of course, the focus is on the cuts ahead. Yeah. What are you expecting for the rest of the year?
From the ECB, I'm expecting further cuts towards the sort of 2%, potentially a little below. But I'm expecting a lack of clear messaging on that from Lagarde, as you'd expect. Given the amount of uncertainty, it's going to be still meeting by meeting.
Yeah, but do you think that they'll drop that language about policy being meaningfully less restrictive?
They may well do, yes, because we are very close to now any estimate neutral.
OK, that's interesting. Then, here in the UK, of course, at the top of the hour, we've got the jobs data to factor in. First of all, are you even taking it seriously? Are you paying much attention to it at this point, given the unreliability of the data that we've heard so much about?
Yeah, I am, but I'm taking it in the round. So looking at all the various bits of labour market data that they publish, including the bits that come from HMRC rather than the survey-based data. And I'm looking at all the various labour market surveys as well. So I think most UK economists are doing that. They're still looking at those data, but they're taking them in the round with all the other information we get too.
And so what are your expectations for these numbers and for the CPI numbers that we get tomorrow? How do you think that's going to impact the BOE?
I think at the margin, absolutely, it will affect the BOE. They're looking for, I think, more reassurance again on the inflation side. They'll want to see potentially a further fall in services inflation, a bit more reassurance on the core messaging, the core inflation and the direction of travel there. And on the labour market, I'm sure they would like to see lower pay growth coming through. I think most UK economists are probably a bit surprised at how resilient some of that labour market data has been. So they probably wouldn't be surprised if things worsened a little in the data this week.
But when you take a step back and look at the UK economy at this point, when we know that, the UK kind of was treated better initially, at least when it came to tariffs, would you conclude that the UK's problems economically are more of their own making at this point?
At the moment, I'm still a bit more worried about the domestic side of things, perhaps, than the global, the international risks. I'm still waiting to see how those April tax hikes get digested in particular. So still a little worried about what the end result of that's going to be for the labour market, how firms are going to react to that.
And of course worries that maybe there'll be even more tax moves in the autumn.
Potentially, yes.
All right, Melanie Baker, Senior Economist at Royal London Asset Management. Good to have you with me, as always. Thank you. We've got plenty more coming up on the programme, so do stay with us. This is Bloomberg. Welcome back to Bloomberg Daybreak Europe. Just before I leave you, I want to bring you a couple of term charts to start your day. This one, in particular, shows just how crazy things have been in markets, how abnormal the recent moves have been. Look at what the moves are on the dollar and long-term Treasury bonds yields over time, and then look at this divergence here at the end. So you've got the dollar on the blue line, and the yellow line are 30-year Treasury yields. That divergence just shows how odd these times are. But, as Scott Bessent says, we really do have to look through a week at the longer-term trends. So let's do that when it comes to equities. Flip the board over. And you have seen a bit of relief when it comes to the S&P recently, but when it loads, you'll see that actually equities haven't recovered to where they were before the tariff day. So still a bit of recovery to do, relief, but not yet a reversal. The other thing to factor in, of course, on top of tariff policy is earnings. And we are kicking off earnings season. We've got $3.5 trillion of market cap reporting this week. As we've brought to you already, a focus on the US banks. But you can see we're just in the foothills at the moment of earnings season. Much more to come in the coming weeks. Let's just go back to that previous chart that I was talking about when it comes to equities. And you can see that the S&P is yet to get back to where it was before tariff day. But let's see what happens in today's session. At the moment, futures pointing lower when it comes to S&P E-minis. Bloomberg Terminal users, though, can access all of these charts and the others that we've used for you throughout the programme by going to GTV Go on your Bloomberg Terminal. And later today, do stay tuned because we've got a top interview for you. At 3:30 p.m. London time, we're going to be speaking to the Hyundai CEO on how South Korea's largest automaker is going to try and navigate these Trump tariffs. So much change at the moment. Tariffs on, tariffs off, but they will bring you more on it on the opening trade. That's up next with Anna, Critty and Guy. This is Bloomberg.